Excellent. So thank you, Derek. I appreciate it. And Angie, the opportunity to present to, the Jumpstart members. For those of you that I have not met, my name is Jason Rodriguez. I work with real estate investors, not as a quote provider, but as a risk advisor. My role is to help investors protect their properties, their income, and their personal balance sheets from events that don't show on the pro forma. So I don't spend my time talking about policies unless they solve a real problem. What I focus on is what happens when something goes wrong, because that's where the portfolios usually get tested. So let's start with a quick question. Just answer this in your head. How many of you consider yourself good real estate investors?
That better be everybody. I'm imagining everybody behind their screen shaking their head up and down.
Now, the harder one. How confident are you that one lawsuit, one tenant injury, one fire, or one prolonged vacancy couldn't seriously damage everything you built in your portfolio?
Less confident head shaking going on now, I'm sure.
So, what I've learned working with investors is this: real estate doesn't fail because of bad deals, it fails because of unmanaged risk. And most investors master returns, as we do know. Got a loan program there, Jumpstart. They cash flow, appreciation, and tax strategy, but very few engineer what happens on the downside. So today isn't about insurance policies or products. It's about a simple framework I use with professional investors, the three pillars of protection designed to answer one question. If something goes wrong, what is actually exposed? Because returns, as we understand, builds wealth, but protection determines whether you keep it or not. And that's what we're going to deal with today. So one quick question before we get into this, I want this to be interactive. So if you have a question that comes up and benefits the whole room, feel free to, put it in the chat and we'll address it. And if something specific to your portfolio, I'll make note of that and we can schedule time after so we don't have to, we don't lose sight of the group. Okay. So
Thanks,
my
Jason. And
goal,
I'll also just mention that we're going to send out the presentation and Jason's contact information afterwards, so you'll be able to get in touch if there's any issues.
excellent. So our first, so the three pillars of protection every real estate investor must have, our topic today. And today is a risk-free framework. Protection isn't the opposite of growth, it's what makes growth sustainable. So we'll walk through the three pillars that we discussed that prevent a single event from wiping out years of work. So right here, we usually do, when we speak to investors, we do investor protection review. So we do a portfolio insurance audit. We want to look at your policies, your limits, your named insureds, your lender requirements, and gaps of insurance. Because at the end of the day, we want to protect your investments. So let me go. You see my screen, right? It's changing.
Yep, I'm on real estate deals. Don't fail.
Okay, yeah. So real estate deals don't fail because of bad deals per se. Most blow up because of unmanaged risk. Not bad underwriting, because they're gonna make sure that you have everything in place in order to get the deal going. But it's them lawsuits, one uninsured loss, one long disruption. That is what makes deals go bad. It's because they don't mitigate properly and they don't have the funds to be able to calculate what happens in the event that you have a lawsuit. So the goal isn't about fear, it's about durability. That's what we're teaching you here today. The ability to stay in the game when things go sideways. So what does that mean? So in order you would and to make sure that real estate deals don't go bad, what do you have? You have to have proper landlord dwelling fire coverages. Make sure that your liability or CGL, if held in the LLC, is intact. And start the conversation on umbrella policies, excess liability early. You know, um, it's usually cheaper when people don't have any claims on their history. So these are the insurance solutions you want to start looking at and doing a property audit of your existing portfolio. So some investor blind spots, uh, Most people, as they do, they focus on returns, as you should, cash flow projections, property value. That's just the given. But what most people do, they ignore critical risk, as we see lawsuit risk, personal asset vulnerability, income destruction from issues, insufficient insurance coverage, weak legal structures, not properly filed LLCs, those things as well. Because we don't know, it's a society where everybody gets sued, and those LLCs get tested in them courtrooms, and I see it all the time. So, in this situation, you want to have coverage alignment checklist. Make sure you have the correct occupancy, correct named insureds, correct valuations. Are you on a replacement cost valuation or you got actual cash value? You want to check the risk, check your perils or the special versus name. These are the things that we go over with our clients as well. You want to make sure that you have high liability limits. You know, not just the minimum. Most people come to, when Jumpstart gives you their requirements, at the end of the day, they want to cover their assets, but you may have gaps in coverage way beyond what they require. So you want to make sure that you're covered as well, because most times is that when they give you their requirements, if something was to happen, a total loss, the only person that's going to get paid is the lender. There's nothing there on the table. There's nothing else on there because all the insurance you got was to cover your existing loan. I see that happen all the time. Hey, just give me enough insurance just to cover this loan. Let me get by, but that's not the proper way to really build your portfolio, because what happens in you starting from zero, you just get the land, and everything else goes, the money goes to the lender because you got the minimum to close. So you want to make sure your contractual risk, your COIs, additional insurance, waivers of subrogation, things of those nature, things of that nature, so you can make sure you don't have a weak legal structure. So these are some of the investor blind spots that we uncover when we speaking to our clients. They say, hey, like, I understand cash flow is very important. And I know the property market in Pennsylvania is it's crazy right now. And I understand that things go up and you want to be able to have that cash flow. You don't want to be putting all your money out on expenses. So you say that sometimes, but you got to be careful with that as well. So optimizing wealth, the synergy of returns and protection. This is where it comes together. So, smart investors understand that maximizing wealth requires a dual focus, pursuing strong returns to grow assets and implementing robust protecting strategies to safeguard them. See, that's the whole thing. That's mainly what insurance does. It safeguards your assets. We put a wall between your personal assets, your business assets, and those coming to get it. So how big is your wall that you're building? So if you got a small wall, they can hurdle that. You got a bigger wall, it's harder for them to get through. And this is what the insurance does. It stops them from coming after you personally, coming after and draining your funds, draining your cash. That's what the insurance companies is there for. So two engines, growth and preservation. Ignore either and long-term wealth breaks. So we need to understand that we have to identify risk, protect the downside, and then you can scale. So this is very important when you're doing it. And some insurance solutions is a portfolio program approach, understand the coverages, as you acquire properties, look at your deductibles, look at what your retainers, what you retaining, see if you got coverage when needed, when flood, earthquake, depending on your geographic, where you located. These are all the things that help you sustain and protect your investments. So we want to make sure we ensure long-term preservation. Okay. You going through this. If anybody had any questions on anything, just put it in the chat. So these are the three pillars of protection. Every sustainable real estate portfolio stands on three foundational pillars. Remove one and the entire structure becomes vulnerable to collapse. Master all three and you create a fortress that weathers any storm, and that's what we're discussing. So of course, the first is asset protection. You want to protect what you own from lawsuits, judgments, and claims. Second is liability protection. protect yourself from tenant lawsuits and legal exposures. Most liability policies, what I love about a liability policy, in those policies, it has a clause duty to defend. And what does that mean? That a liability policy connected to your property, you have a lawyer on retainer for that policy premium. So lawyers today they charging $400-500 an hour. So if you're just saying your policy premium for the year, your liability part is 400, your property part is say 700, comes up to $1,000. For $1,000 in a year period, you have uh, a lawyer on retainer that sometimes is outside of the $1 million limit that you have on your general liability. So that alone, we should all have a general liability policy because you have a clause in there, duty to defend. So you have a lawyer on retainer for any lawsuits, anything that comes your way, any claim against you on property, you file that right to the insurance carrier, and they have a lawyer defend you. So you won't be liable for anything that comes. They're here to protect you. So just that part alone is invaluable. And of course, income protection, protect your cash flow from lifestyle disruption. So that's one of the pillars, and that's our people protection. Having the proper protection on yourself because your most valuable asset is your ability to earn, your ability to be there to learn. And if you're not there to be able to put plays in motion, then everything stops. So what helps you with that is life insurance, key man insurance, disability insurance. These are the insurances that can help you protect yourself, your property, your liability, income, loss of rents, things of that nature. So these are three pillars of protection. So today I'm just giving you an overview of the protections to protect your real estate portfolio, but we can go into depth at a later time as well. So pillar one, as we discussed, asset protection. So asset protects acts. If something goes wrong, what is exposed? LLCs is the first step, to asset protection. Everybody say, go get your LLC, which is the first step. Professional protection is structure, separation, plus investor grade insurance. So there's multiple parts to that as well. As we understand, LLC alone is not enough to provide truly comprehensive asset protection. So we want to make sure that we have the proper policies in place to be able to protect our portfolio as it grows, and they won't be able to pierce our LLC. So the first one is asset protection. That's the first thing, protection. You want to protect your assets while you're growing your portfolio. So pillar two, as we discussed, is the liability protection. Real estate is a lawsuit friendly business. We understand that people slip, people fall, come on your property, especially if you're a landlord, if somebody has fights on there, if something happens in that property, then you're liable. They always want to come back to the owner of that property. We see all types of things being on this side of you may not see it, you may not have these claims, but us being an insurance agency, we see all types of uh, allegations. We see all types of claims that come into our office, and you want to, some of them be like, wow, if you haven't experienced them, you wouldn't know. So you want to make sure that your liability protection is intact and you have the proper liability to protect against these things. That if somebody says they slept and fall, or they claiming negligence allegations or anything, you're protected. So for this particular, you want to make sure tenant, the common one is injuries, false accident, property hazards, things of that nature. And then of course, you got the slip and falls. You got the alleged negligence, legal defense costs. And to cover this is, like I said, having a proper commercial general liability policy, umbrella as well. There's a lot of things that, you may need to be able to protect yourself in this particular situation. But liability protection, remember I told you about that duty to defend clause in these liability policies. that gives you a lawyer on retainer for the price that you're paying for your GL already. So that's a plus in itself. So pillar number three, income protection. Cash flow is the oxygen. Without it, everything else suffocates. We understand that. So, we have mortgage payments, maintenance, growth plans, your personal lifestyle as well. Yeah, most investors operate without any safety net for income disruptions. So what? Property loss. These are things that can happen from flood, major. I know people that go without having insurance on a property sometimes. You know, when we talked about loss of key operators, property managers, business partners, essential team members, these are all vulnerabilities that you may, as a real estate investor, incur. And we just want to make sure that you understand them so you can protect yourself against them as well. So, rental income interruptions, uh, illness or investor illness or disability. It's a big one right here. What happens if you get sick? What happens if you can't, no longer provide income for that property? Some people have other jobs. You know, I know a lot of real estate investors when they invest in, they also do something else. They have a main job. Some of them retired, don't want to go into your retirement funds or your other jobs. So you got to make sure that you have everything in place in the event that something happens to you. So that's the key. So, and we understand if income stops, everything else follows. Mortgage payments don't pause. Property taxes don't wait. We understand that. And insurance premiums as well don't skip. Your portfolio needs income protection to survive disruption as well. So, so how do pillars work together? So the real power emerges when all three pillars work in harmony. Individually, each provides protection. Together, they create an engineered system of stability that allows you to invest with confidence. So we understand the pillar one, make sure that your assets are insulated. Legal structure to prevent one problem from cascading across your entire portfolio. So making sure that everything is in place. Of course, your liability lawsuits are absorbed. You don't have to worry about these things when you have a proper liability policy in place. It's because it's designed to contain legal threats before it reaches you personally or your LLC or any of your assets. And of course, income continues during disruptions. You want to make sure that if something was to happen to you, you have a contingency plan in place. Something was to happen to your properties, you have a contingency plan in place to be able to make sure that the income's still coming in if something was to happen. So these are how they work together, the pillars. We flying through this. We flying through this.
Yeah, again, if anybody has any questions or chat, feel free to type those in and we'll get to those when Jason's done his presentation.
So, we wanna understand to protect first, protection. The foundational pillar is protection. Then you can build on top of that because if your foundation ain't properly protected, then you building on quicksand. Anything else could just fall apart. And you want to grow on top of that. And this is the recipe to win long term. So this is the key right here. You don't rise to the level of your returns, you fall to the level of your protection. So, before you close your next deal, before you add another partner, before you celebrate another year of cash flow, ask yourself one question, and it's right here on my three pillars solid. Do I have the proper asset protection? Do I have the proper liability protection? Do I have the proper income protection? If any pillar is weak or missing, your entire portfolio stands on unstable ground. So we want to make sure that you're on stable ground, you're building on a strong foundation so you can sustain and win in the long term. So we have to this is really it. We're here, you know. Let's connect. If you have any questions, we could talk about it. Got some time right now to discuss.
Yeah, yeah. Hopefully, we get a few questions in chat here. The one thing, Jason, I did want to say that resonated with me is I'm way too used to looking at the insurance policy coverages to see if it covers our loan amount because that's our
Yes,
requirement, you know. But I think what you highlighted is extremely important on the reverse side, where you know you're not just getting enough like you're getting the insurance coverage for yourself, inspect your own liabilities, not just because it's a jumpstart requirement, you know. And I
correct.
think we could definitely, as a lender, be more outspoken about that, being like, oh, you know, you got this insurance policy for, you know, $500 over what our loan amount is. You know, did you think about what if this, or this happened? And that might be something we should really, you know, have people think about at the top of a project rather than deal with it
Yeah,
through.
and and you know, and when people get it like that, they have not had a claim yet. So
Right.
they don't understand the implications of that strategy. Just saying, hey, this is what Jumpstart requires, or this is and this is how they've been trained to purchase insurance. Even when they're renting out a building from somebody else, the landlord requires this.
Mhm.
This is all I need. But on the other side is, hey, okay, the landlord requiring this to cover themselves,
Mhm.
or the lender's requiring this to cover them. This is what you need to cover you. Because
Yep.
at the end of the day, the lender's going to get paid and you ain't going to have nothing but an empty lot.
Yeah, and I think you're totally right where people should be a little more I guess aware of what's going on with their insurance policy and everything because a lot of times we're notified that a policy is canceled or lapses or you know it goes beyond the coverage period or whatever and then you know we have to then notify the borrower that the insurance is taken out and what if something were to happen in between that time period of when it expires and when we get the notice in the mail and then have to you know inform them about it and kind of get through the to get to the bottom of it and how we can get it reactivated. So yeah, I think this is definitely for me at least as a loan officer going to change those conversations a little bit with the borrower about their insurance. We do have a couple questions here. One is from Edward. He says, I've never seen an insurance presentation like this. I know he means that as a good thing. How do my wife and I schedule a consultation? So, how can people get in touch with you to set up like a one-on-one meeting to discuss their portfolio protection?
You can just click that QR code right there.
Okay.
That's my digital card.
Mhm.
And on there as well, you can go to my calendar and schedule a time to connect.
Great. Awesome. Yeah. And like I said, I'm going to send out your presentation and contact information, and I'll put that QR code link in as well, so people can follow up. Thanks, Edward. Jamila asks, as a new investor, what's a good starting point for selecting a policy and coverage amount? So, um, from Jumpstart's perspective, you know, we do require the builder's risk coverage for as much as the loan amount and the general liability of 500,000 for, you know, the premises. Jason, outside of that minimum lender coverage, if this is their first property they're buying and you know it's the start of their portfolio, what would you recommend from the onset there?
So what we recommend is also you want to, because I know you do the builder's risk side of it, and then they got to get stabilized insurance. On the stabilized side, is always replacement cost valuations.
Mhm.
But initially, you always want to cover the cost of how much you got in it and what the rehab cost is going to be. So
Mhm.
if acquisition cost for a property is 100,000 and you're borrowing 185,000 to rehab it, you want to do $285,000 as an initial start. So you can cover yourself and cover the loan amount as well. You always want to cover yourself. So that's how you would start initially. What is the acquisition cost and how much is the rehab cost?
Yep. And yeah, I think that's a perfect point. Whereas Jumpstart, we lend at 85% loan to cost. So our coverage requirement is just for what we're lending you for the property, right? So you like to your point, Jason, you should really get that dwelling coverage, you know, if you want to protect yourself fully for not only just the 85% that Jumpstart's lending, but the 100% of the total project cost, including the 15% that you're bringing out of pocket towards closing, because that's part of the equity in the property, what could be at risk. Um, so hope that answers your question, Jamila. I do see Melissa message as well and said, when do we get insurance? Jason, do you want to mention when the best time to obtain a property insurance would be?
Yes, once you under contract.
Yep. Yep. Before
But
closing.
they won't allow you to close unless you won't be able to leave the closing table unless
Exactly.
you have a policy in place.
Yep. So it's a step in that process from between when you sign the agreement of sale and as you're working to get lender approval and doing your financing contingencies, your home inspection contingencies. That's when you're going to be reaching out to insurance agents, perhaps Jason, getting quotes for the policy that your lender is going to require. So it all takes place between, in that pre-closing process, after you get it under contract, before you actually start the loan. Good question, Melissa. All right, and that looks like all we have for now. Jason, was there anything last, things you wanted to add before we wrap up?
No, I mean, I appreciate the opportunity. If anybody want to reach out to me, you have my contact card right there. Scan the QR code and let's connect.
Great. All right. Thanks so much, Jason. For Jumpstart, just a reminder, this is our last JUMPinar of the year. So thanks for a wonderful year of events. And we covered so many topics I can't even begin to recap what we did. But our next JUMPinar will be the first week of January, January 7th. It'll be a meeting with Kenesha, who is the chief, I'm sorry, Dockery, I think Kenesha Dockery. She is the chief of staff at L&I, and she'll actually be presenting on easy permits. So we're really excited about that, and be sure to go to jumpstartgermantown.com on the events page and RSVP so you get notified about the details for that. Um, I believe that's it. Jumpstartgermantown.com, jumpstartphilly.com. Look out for an email from me tomorrow with Jason's contact and slides. And Jason, thank you so much again. Hope you have a great rest of your evening.
I do the same. Thank you and have a beautiful day as well.
Have a good night, everybody.